Make sure that we are live. Let me see here. Live. We should be live. I'm gonna check my sound and everything and see if everybody's in here. Hello, everybody. Make sure that we are live. Let me see here.
In an era of online retail where...
Okay, let me just check my sound and make sure the chat is working. Can everybody see me and hear me? Can you guys see me and hear me? Sounds good. All right, perfect. So tonight's webinar is going to be a long one. We are going to dive in and go through a lot of things. And I think this is probably the most important video when it comes to trading. Somebody was asking me earlier to really focus on strategy. And I don't really feel comfortable focusing on strategy until you guys really get a handle on two components of trading. One is psychology. Hold on, let me make sure. Okay. Hear me somewhere. Let me see where that's coming from. There it is. Okay, perfect. Okay. All right, so we've got about 100 people on. What's up, guys? So there's two components that I think are more important than strategy. Strategy to me is about 5 to 10% of trading. Even more than important than that is trade psychology. When it comes to discipline, patience, managing your emotions, trade execution, following your plan, all of those things go into more trade psychology, what to do when you're underwater on a position, taking profits, all that stuff has to do with psychology. And yes, there's a little bit of strategy in there, but more important than all of that is psychology. And so for psychology, there's a really good book called Trading in the Zone by Mark Douglas. And I would say psychology is 50 to 60 maybe even more % of a trader's success. The best traders in the world, they are masters of their psychology and being in the right state of mind to trade. And part of that comes in my 21 trading rules of crypto, which you can find on my podcast and on some old videos. But in today's video, what I believe is 30 to 40% more important is mastering risk management. Now, position sizing is a part of it. If you guys saw my video, I think it got 30 to 40,000 views just a couple weeks ago on the most important formula before you trade Bitcoin or Forex. Now, that's position sizing. We're going to talk about position size, but we're also going to talk about a lot of other terms and how they relate to position sizing. We're also going to talk about leverage and how that factors into position sizing. So let's dive right in and we're going to talk about that. So for all the formulas that we're going to talk about on today's live stream, you can download them at bit.ly/risk management guide along with a position size calculator. Now this position size calculator was created and provided by CryptoZide on Twitter. So throw him a shout out, throw him a follow. I appreciate you, buddy. Those formulas, you can find all those along with a position size calculator that's yours to keep. All that stuff's free. So before we get into it, I want to go over some disclaimers on margin trading. I talked about this on my Bybit tutorial video, but I do think it's important to talk about these things again. And I will be reading chat and we will be jumping into a Q&A at the end where I'll answer all your questions. So first and foremost, margin trading is very high risk if done inappropriately or incorrectly. So you always want to practice on the test net before actual trading so you understand the mechanics, the fees, the leverage structure, liquidity, all that stuff. You want to practice on the test net first, get comfortable with it, practice out your strategies, and then once you feel comfortable with it, once your win ratio is doing pretty good, then you can migrate over to the main net or to the actual exchange. And what I would recommend is trade with an amount of money that you feel comfortable losing, especially if you're beginning out trading. I just tweeted out, maybe a week ago that the first year to 2 years of a trader's career are what we call the tuition years. You're inexperienced, you don't know what you're doing, and so you're losing your money to people that have been in the game for a while. while. And so it does take time and persistence in that 10,000 hour rule to really become a masterful, profitable trader, but it's well worth the effort if you can get to that end game where you can make that consistent profit. Number 2 is doing your own research. I'm not a financial advisor. My opinions are my own. And keeping your money on exchanges is always a risk, which is why I really like margin trading. And I'll explain why in just a second. Study the basics of trading and practice spot trading before you jump into margin trading. If you don't know how to calculate your position sizes, if you don't know the basics of moving averages, trend channels, support, resistance, go back and learn that stuff. Lots of helpful stuff on YouTube. So why margin trading? Well, it allows you to access more capital to trade bigger position sizes for more profit. It allows you to more volume and liquidity than altcoin trading. A lot of altcoin trading has seen record low volumes in the last year. And a lot of it is because a lot of interest is shifting over to margin trading. Now, I've always steered newer traders and beginner traders away from margin trading, but with the mass amount of interest that's in the space, I decided to do this tutorial. I reached out to Bybit, and I wanted to do this in partnership with them so that people, especially newer traders, didn't get wrecked trading. So that's a big part of why I'm doing this series. So, and also if you guys do have questions while I'm going through, feel free to throw them in chat and I'll read back as we go through. Or if you have any questions on anything specific as I talk about it. So also margin trading allows you to trade both directions in the market. So it allows you to long when the price is going up, and it allows you to short when the price is going down. So it allows you to take advantage of the volatility and also the market cycles that cryptocurrency kind of allows for. And it's easier to focus on a few coins, more than 5,000 plus. I think there's like 4,950 altcoins, and it's really hard to scan through on Binance. I think there's 300 or 400. On Bybit, there's 4. There's Bitcoin, Ethereum, EOS, and Ripple. So it's pretty easy to focus on just 4 coins rather than all the other ones. It reduces counterparty risk. And what I mean by that is counterparty risk is actually having your money on an exchange. We've seen hacks. We've seen FBI, CIA seizures. We've seen founders die and customer funds get locked up. We've seen all kinds of crazy stuff happen on exchanges. And so margin trading allows you to decrease your counterparty risk, because with leverage and margin, you can actually trade with a large position size. So let's say you have $100,000. Well, you can keep $20,000 in exchange, $80,000 in cold storage or in stable coin, and then you can use leverage to be able to trade like you've got a $100,000 portfolio. So it's nice for that. And it also allows for hedging on long-term holds. Same concept as that counterparty risk, except instead of keeping it in like stable coin, let's say you've got all your Bitcoin on an exchange or in cold storage, and maybe you don't want to sell it for capital gains taxes, so long-term cap gains, you want to get that discount, but you still want to hedge against the volatility or maybe against a 50% drop, so you want to lock in USD value. So margin trading allows for that because you can trade both directions in the market. So why do people fail at margin trading? I do think it's really important to go over this stuff so that you kind of learn from what other people are doing and losing their money with. So the fastest way to lose money is if margin trading is done incorrectly. If you're 100xing with your full capital balance without stop losses, yeah, that's gonna burn up your capital pretty quick. And also if you don't understand the fee structure. So people are drawn to high leverage trading and they love to go all in on trades because they're in a gambling mentality rather than a and let me make sure that my okay, this was on. That makes a little more sense. Okay, and I'm gonna shut down my Dropbox here. So that's okay. And we're just going to do this again. Sorry about that. All right. I had my blue blocker on. It was kind of pinkish. So they have a complete lack of risk management, and that's what we're going to cover today. They don't understand the fee structures. They improperly calculate position sizes. They don't know how to hedge positions. They don't have a trading plan in place. They kind of trade blind. They trade mid-ranges. They're not actually trying to time entries and exits. They're just kind of hoping to get lucky. And they're also inexperienced traders that are trading on margin. So today's video is in partnership with Bybit. As I said, they did sponsor this video for a nominal fee. Bybit is a margin trading exchange, otherwise known as a broker. I've been personally using Bybit exclusively for the last 7-8 months. I'm a power user, so I can talk about it quite well. It's a peer-to-peer trading platform that allows you to trade against other people. Now, a lot of people get confused because they think that Bybit wants you to lose your money. That's not true because Bybit makes their fees off of you. It is a zero-sum game. You're trading against other people, so it is a competitive market. And that's what part of this is about managing your risk and understanding that. So they make money through fees on buys and sells, and the job is to provide a liquid market. And I really like Bybit for a lot of different reasons. But the key advantage to using Bybit is they have USDT, so you can actually keep your portfolio in a stable coin rather than having it in Bitcoin. And I really, really like that about the platform. They also have really, really easy take profit stop loss and trailing stop losses. They've got limit market, conditional order types, 1x to 100x leverage options, post only, close on order, reduce only options. All these things are really, really helpful. And again, they've got that USDT added as an asset. And they're also pretty fast. They do lag sometimes depending on the market conditions, but it's a much better performance than I've seen on BitMEX and some of these others leverage trading exchanges. So managing your risk is the most important aspect of trading, in my opinion. That and trade psychology. The strategy, all that stuff is less important. Managing your risk is more important, okay? So not losing money is more important than making money. Capital preservation, so that you can be ready for those opportunities when the money making opportunities come. And a lot of people, they overtrade, they get chopped out of the market, and so not losing money is very, very important so that you can be ready for the ideal trade setups that you'll figure out. So trade the plan and plan the trade. Very, very famous quote, but this is very, very true. And now I do want to emphasize that you can do things wrong and still make a lot of money. And I'll say a lot of people that came into 2017 market, this quote kind of embodies them. They did a lot of things wrong. They didn't have maybe the right position sizing. Maybe they went all in on Tron or Ripple or Stellar or Bitcoin or whatever. So they went all in. They didn't have a stop loss in place. They weren't really planning on when to exit. They were just kind of holding just to hold. Okay, and they were hoping that it just went up forever. So without having a plan, you can still do wrong things and make massive gains. We saw that in 2017. The flip side of that is you can do things right and still lose money. So you can have the perfect plan, you can have the perfect strategy, you can manage your risk perfectly, and you can still lose money. That's what trading is all about. Sometimes you get those stop loss hunts where they take you out of a beautiful position and then it dumps right after or pumps right after, and you're in the right trade, but maybe you got stopped out and your plan didn't go accordingly. So you can do things right and still lose money. So it's important to remember those two things, okay? But if you do things right long enough, consistency will win out in trading. The most important thing is to create rules for yourself and always follow them. Are you going to stick to 1% risk, 3% risk, 5%? Whatever your rule is for yourself, depending on your risk tolerance, stick to that, okay? And make sure you always stick to your rules. So what is risk management? It's understanding all the different various terms that kind of come along with risk management. And I'm going to be going through a lot of different terms and concepts. And so if you have any questions about these things, let me know. And it's going to be a lot of calculations and formulas. And it's really important to understand the basics of these things. Like if you use the RSI, it's really important to understand the RSI and how it's calculated. Same thing with a moving average. What is the moving average or the MACD? So same thing with understanding the fundamental basics of your oscillators or your indicators. Same thing with risk management. You want to know how these calculations work so that you understand how they work on the exchange. So understanding your risk amount, always knowing your risk reward ratio for each trade, your setup entry quality, and your position sizing that goes along with it. Using stop losses to manage your risk, closing trades in profit and using take profits, using proper position sizes based on your portfolio that is ever changing, and then unemotional trading strategy. So that kind of encompasses risk management. Less talked about topics in risk management is setting higher rewards during better market conditions. Maybe the market's trending really hard. Lowering your risk during poor market conditions. Patience of market setups for higher risk reward. Using derivatives to mitigate risk and hedge assets like futures markets. So like December's contract, March contracts, May contracts. And so those things are a little bit more complex, but we will get into those down the road. When to stay in USD or stablecoin or Bitcoin during bullish or bearish trending markets to increase your purchasing power of your underlying asset of your portfolio. Those are less talked about topics, and sometimes depending on what I think is going to increase the most, I might switch my base asset to Ethereum or Bitcoin or USDT. So those things are less talked about, but we will get into those at a later date. This video here is mostly for beginner traders to really, really understand their risk management. Now, a lot of new traders, they don't understand the concept of having a low win rate, but still being highly profitable. You can have a 20%, 30%, 40% win rate, meaning out of 10 trades, you only win 3 out of 7 or 3 out of 10. You can still be profitable if you understand your risk reward and your trades are hitting those risk reward targets. The goal of proper risk management is to be consistent and unemotional. Trade like a robot, trade like a bot, follow your rules, okay? Let your winning trades win and cut your losing trades quickly. So here's what we're going to get into tonight. We're going to get into all of these different terms, and then we're going to go over examples on the Bybit platform of integrating all these things together. So you've got portfolio, position size, risk reward, risk per trade, drawdowns, recovery, win rate, expectancy, margin, liquidation, cross margin, isolated margin, laddering in, and laddering out. Okay, so we're going to talk about all of these things, and all these things, when you put them all together, will make you understand how to manage your risk like Wall Street traders, professional traders manage their risk. Okay, so margin, this is, what is margin? Well, margin is considered borrowing from an exchange or broker, and margin will be the required amount that each trader will need to have on hand in order to borrow from the exchange. So it's kind of like your initial ante into a poker table, right? You need to have that ante just to get a hand at the table. So margin is that initial capital cost to just enter your position, okay? And it's tied very closely to leverage, and I'm going to explain how that works, okay? So margin requirement, and that's this thing down here on cost, okay, right here where you see cost. So margin requirement or order cost is the amount of margin required to open the position, and it is expressed as a percentage of the pull position size or notional value of the position you wish to open. So I'll explain that a little bit more in detail, but just know that that's the kind of initial capital cost just to open a trade. So leverage allows you to control more of the underlying asset that you choose to risk. So this means that with 100x leverage and a capital of $10, you can control about $1,000 worth of whatever asset you're trading. Now, I am doing this video specifically about crypto, but this video can apply to stocks, it can apply to Forex, it can apply to commodities. Risk management is the same across the board. There's a few different nuances, but by and large, this will help you a lot with any market you trade in. So you use margin to create leverage, and margin has an inverse relationship to leverage. The more leverage you use, the less margin is required for your position size. And some of these concepts might be a little bit basic, but once we start going through some of the examples at the end, you'll really understand that. Liquidation is when the mark price, index, or the last traded price, whatever you choose as your liquidation before you enter the trade, of a contract falls below your liquidation price for a long or rises above your liquidation price for a short. Your maintenance margin level has been breached, and the liquidation engine will take over your position and it'll close it out. Your position gets closed by the exchange and you lose the entirety of the funds of that position. So cross leverage. Cross is a type of leverage where an entire account balance can be used for any open positions instead of a separate margin requirement per position. Now, cross leverage is really, really interesting because most pro traders use cross leverage, but it's very, very, very important to use a stop loss when using cross leverage, or you run the risk of losing your entire account if the trade moves really, really quickly. So it's very, very important to understand cross leverage and the dangers of using cross leverage. So if you're a newer trader, I would recommend sticking to isolated leverage. And this is the opposite of cross leverage in that you only use a portion of your account balance in the position. So if the position gets liquidated, it doesn't add funds to the position to decrease that liquidation level, and so it'll just automatically take your full position. But either way, with isolated or cross, I'm going to recommend using a stop loss, and stop loss is what I call an anti-liquidation countermeasure, okay? And so that stop loss prevents you from being liquidated and makes sure that it stays at that risk amount that you put on each trade. So those are the margin trading terms. These are the basic terms that we kind of want to understand, and then we're going to start getting into the calculations and how to track all these things. So portfolio is the total value of the amount of money that you're trading with, and this can be in Bitcoin or USD or Ethereum. Whatever your base asset is, that's going to be your portfolio. And it's important to always know your portfolio balance so that you can always know how to calculate your position size. So each time you look at your trade, I'll go to it on Bybit. You want to understand that. So RR, otherwise known as risk reward. I talked about this on a few other videos, but I want to talk about it more on this one, go over it really, really diligently. So the reward risk ratio is equivalent to the reward that you're going to get from the trade divided by the risk value. So how much you're risking on the trade as opposed to how much you believe you're going to profit on the trade. And then you divide those two by each other, and that's going to give you your risk reward. And it's usually represented by a ratio or a whole number. In this case, example 4-to-1 or 4-to-1, or they'll say just 4R or 4RR. It can be said a lot of different ways, but you want to make sure that your RR is in line with some of the other concepts that we're going to be talking about. And it also represents how fast your winners will offset your losses. So an example, buying Ethereum at $100, your stop loss is $90 and your target is $120. So basically, if the trade goes against you, you're going to lose $10. If you hit your profit target, you're going to win $20. So your risk reward would be 20 divided by 10. And so your risk reward is going to be a 2 or a 2-to-1 reward ratio. The simple calculation, like I just went over, is target minus entry, entry minus stop loss, and then you divide those two. And remember, if you want all these formulas, I did give that cheat sheet download that you can get all these formulas. So to calculate an example, let's say you're trading Bitcoin and your entry price is 3,500. It'd be beautiful if we got those prices again. Your target price is 38.50 and your initial stop loss is 34.50. So your reward is 38.50 minus 3,500, and that equals $350. Your risk is 3,500 minus 34.50, and that equals $50. So your risk reward ratio is 350 divided by 50. Now I am going to bring up this calculator so that we can do this together. So when shorting is a little bit different, and what I would say is, oops, let me bring up that calculator again, is what you can do is you can actually flip these around, or you can just divide the negative numbers. So target minus entry, entry minus stop. So we'll just flip this around really quick for short selling. So 38.50 minus 3,500. So if we were going to short, then let's say that 38.50 was our entry and our stop loss was 39.50. So our potential risk is $100. And so what we do is we'd take 38.50 minus 39.50, and so that would be negative 100. And then our reward, let's say, is 3,500. So if we're shorting at 38.50, we take profit at 3,500. Our spread is $350. And so then what we would do is the same exact thing. We'd take 350 divided by 100. And that would give us a 3.5 risk reward ratio on our short. You just have to divide them, and they should both be negative numbers if you use this exact same formula. But shorts, you just want to make sure that you calculate it a little bit differently, just because the number is above. So the thing about losses, and the thing about why we want to factor this in risk reward ratios, is because of what we call drawdowns. So if your position goes down 5%, the next trade, so let's say you get stopped out for 5%. The next trade, all you need is a 5.3% trade to get back to break even, or you need the trade to move up 5.3% to get the trade back to break even. 10% down, you need 11.1%, and so on and so forth, all the way down. So some people from 2017, they actually held altcoins from all-time highs all the way down to negative 90%, negative 99%. And the likelihood of that trade coming back, you're going to need a 900% move for that trade to come in play. So that's why all the way back since 2016, I've been preaching the concept of stop losses, at least setting them in, especially if you're up 3, 4, 5, 600% on a position. You let your stop loss take you out, and you're out of the trade, but at least you've locked in some profits. Okay. Now you can set stop losses 20% low as long as you understand how to calculate your position size. Let's say you're swing trading and you want to play the volatility, but you don't want to get taken out of your position. You can still use that as long as you make sure that your risk reward is at least, let's say 40%. So when you talk about risk reward ratios, this is basically trading metric for offsetting losses. So on a 1-to-1 risk reward, so let's say your stop loss is $100 and your take profit is $100. That's a 1-to-1 risk reward ratio. That basically means that your winning and losing trades have the exact same size. On a 2-to-1 win ratio, your winning trade is twice as big as a losing trade. So your take profit is $20, your loss is $10. On a 4-to-1, your take profit is $40 and your loss is $10. $10. And on a winning trade, it's, $100 and your stop loss is $10. Now I'm going slow and I'm trying to go over this stuff and explain it really, really well, because I've had a lot of comments from newer traders say that I talk too fast. So if I'm talking too slow, just know that a lot of people are benefiting from the slower pace, okay? So win rate and risk reward, winning and losing have the same size. That's a 1-to-1 RR. So you need at least a 50% win ratio to remain profitable. When you've got a 2-to-1 RR, all you need is a 33% win ratio. This is not counting fees. 1 out of every 3 trades needs to be a winner. 4-to-1 RR, 20%, and on a 10-to-1 RR, 10%, or about 10%. I think that calculation was a little wrong. So risk per trade. Now this is where I'm going to get into some of the formula that you guys understand already, but this is where it's going to get a little bit more into the mathematics, and then we're going to go through a lot of examples on Bybit, and I'm going to do all these questions, okay? Are you guys liking this so far? We've got about 200 people on. Okay. So risk per trade. The percentage of your total portfolio you risk per trade, dependent on your RR. Okay, so recommend trading size or risk amount is 1 to 3% of your total portfolio. If you're a new trader, I would highly recommend sticking with the 1% risk rule. Standard position sizes across Wall Street is typically 1 to 1.5% amongst most professional traders. You will find very few traders that trade with bigger position sizes. Because remember, trading is a game of consistencies. It's a game of longevity. You want to be around to be able to trade for a long time. You don't want to get taken out in your first 10, 20, 30 trades. Okay, because you want to have the time to build that learning curve. So you want to protect your capital by managing your risk. If you allocate 1% risk on a trade, you have 99 other trades. If you lose your first 5, 6, 7, 8 trades, that's okay, because you're only going to be down 7, 8% portfolio capital, and that's a good thing, because it'll give you the length of time it needs to gain that knowledge. So riskier and more aggressive traders use 2 to 5%. That's maybe if they have a really, really strong setup that they believe in with a lot of confluence, a lot of indicators saying that it's a good trade. Smaller position sizes help you to remain unemotional and biased. So if you're getting nervous, or if you're uncomfortable, or you're scared in a trade and you're like, oh my God, it's going to hit my stop loss, it's going to hit my stop loss, then you need to maybe use 0.5% risk, or even lower. Until you get over that kind of emotional insecurity about your trading, and that'll help a lot. Because when I hit a stop loss, I mean, it's not even a blip on the radar. It just, it happens. When you have 10, 15, 100,000 trades in your career, it's just kind of one, it's just another stop loss. So I want you to get to that point, and if you have emotion coming in, either the fear or the greed or the, anything like that, I'd recommend reducing your position sizes until that happens. And also I recommend reducing your position sizes if you're losing on a consistent basis. You'll see a lot of professional traders, they'll take a break, or they'll reduce their position size until they start kind of getting their wins back. So the amount of risk can change. And what I mean by that is it scales depending on your portfolio. So the percentage can stay the same, so 1% risk. But the risk amount will change depending on if your portfolio goes up or goes down. So if your portfolio goes up, then the risk amount will go up with it, but the risk percentage, the risk per trade, stays the same. And if your portfolio goes down, then the risk amount goes down with it. So it scales accordingly, okay? So the risk amount, again, is the total amount of money you're prepared to lose expressed as an amount instead of a percentage, and that's what risk per trade is. So this is not your position size. It's the amount of money you're going to risk if your stop loss is triggered, okay? So your formula for the risk amount is your risk per trade times portfolio size. So your risk per trade is the percentage, 1%, 2%, 3%, 5%, and the risk amount is basically that portfolio size times your risk per trade. And this is what I mean by scaling up and scaling down. So 1% of 1,000 is $10. That's what you're going to risk on the trade. 1% of 5,000 is $50. 1% of 10,000 is $100. 1% of $100,000 is $1,000. This is what I practice. My position sizing is always based on this rule set, okay? And I did not start out with $1 million trading portfolio, okay? It took a long time to build up to that, and I've been trading since, for a very long time, back when I was 18, and in the beginning, I did not use this, Okay, I did not understand risk management very well. I was going 50% of my portfolio in trades and I would make a ton of money quickly, but I would lose a lot of money quickly. And every trader has blown their account one way or another. Ed Secoda, one of the greatest traders in the world, Richard Dennis, one of the greatest traders in the world, these guys have blown their accounts, and you're talking 10, 20, $50 million. And the number one reason why they have all done that is because they always risked too much on a trade because they thought it was a sure thing. So always keep that risk amount the same for you guys based on your risk tolerance. So what is your risk? That's the stop loss distance. You need to know your stop loss before you can calculate your position size. Okay, so we're going to get into position sizes and all that stuff. Is my head still big? I can make it a little bit smaller if we need to. Okay. I'm going to go through a lot of these questions at the end though. Okay, someone was asking about Bitcoin and stuff. So knowing your risk percentage will allow you to calculate your position size. So your position size is the number of the amount of money that you're going to put into a trade, okay, whether that's USD or Bitcoin. And it's the percentage of your portfolio that you're about to risk, okay, and that's your position size. So you divide that money amount by the price of the crypto, and this gives you your lot size to purchase to manage your risk. So your position size calculator is very, very simple. I did a video on this a little while ago. Your position size is the risk amount divided by the distance to the stop loss. I'm going to show you how to calculate the stop loss too, but I'm just going to go over it in Bybit as well. But so position size, simple calculation. Your portfolio size is $10,000. Your risk per trade, that's your, the amount of money you're willing to lose out of your portfolio is 2%, and your stop loss is 4%. So we'll do this together so you kind of understand this. But I'll give you the simple the calculation. So $10,000 portfolio, and you feel like risking 2% of that. So you're willing to risk $200. Okay, so that's your risk amount. So remember, risk amount divided by stop loss. Your stop loss is 4%. So you want to express that as a decimal. So you divide by 0.04. And that comes out to $5,000 position size. Okay, so on that $5,000, that's where you're going to input in the quantity USD in Bybit, and I'll show you how to do that as well. For Bitcoin, it's a little bit different, okay? And so let's say we're going to trade the XRP BTC pair, and we can also do, XRP USD, but in this case, so your portfolio size is 5 BTC, risk per trade is 2%, stop loss is 5%, so same concept, 5 times 0.02, which I think is 0.1. We'll do that together. 5 times 0.02, 0.1 divided by 0.05, that's your stop loss, and that gives you a position size of 2. So it's very, very important to understand that just because I say risk 2% of your portfolio doesn't mean that you only risk $200 out of 10,000, because when you divide that by your stop loss, that gives you your total position size. So you've got 2 Bitcoin that you can put in this trade if your stop loss triggers when it's supposed to. So again, your position size is 2 Bitcoin with a 5% stop loss and a total of 2% portfolio risk. And that's how you calculate that. Very, very simple. So your contract size calculation is a little bit different. You don't need this on Bybit, but you do need this on other exchanges like Binance and a few other things. So your position size divided by your entry price equals your contract size. You don't need this for Bybit, like I said, but it is always helpful to understand. So the difference between let's say spot and let's say margin is that you can use leverage for your position size. So your position size divided by your leverage amount equals your initial order cost. So let's bring up our calculator one more time, and let's say we've got $5,000. So that's our position size. And let's say we want to use 10x leverage. And then it's going to be 500. So basically our total initial margin requirement is going to be $500. And so to calculate that, you basically just divide by the price of Bitcoin, and there you've got your capital requirements for the trade. But very, very simple and easy to calculate on Bybit, and I'll show you how that works with the leverage slider. But the leverage just helps you to get to your position size with less capital rather than putting up more capital. It allows you to trade with bigger position sizes if your stop losses are less than your risk per trade. So the thing with position sizes is that they compound as your portfolio goes up. Your position sizes get larger, just like the risk amount, scales up and down, and it also gets smaller as you lose trades. So this is kind of what it looks like. So as you win trades, your position size gets bigger and bigger and bigger. And as you lose trades, your position size gets smaller and smaller and smaller, similar to the risk amount. So that's everything you need to know about position sizes, risk per trade, risk amount, stop losses, all those things. So what we're going to do now is we're going to open up Bybit and we're going to show live examples on how to calculate all of those things. And then I'm going to do a Q&A with you guys, and I'm going to answer as many questions as you guys have, and then we'll go from there. So by knowing your win rate, you can increase your position sizes because your risk is lower with a high win rate percentage. So your win rate allows you to calculate a lot of those things. Your risk per trade will allow you to quickly calculate your position size. And by having an RR per trade, you can remain profitable with a lower win rate percentage. And then leverage is completely irrelevant to your position sizing and risk management strategies because all it does is just lower your initial order cost per margin. So again, if you want to get all these formulas, you can download those at bit.ly/risk management guide. And I'm going to bring Bybit down. And I'm going to show you how to do all of those things that we just talked about using the platform. So, all right. So I'm going to read through some of the chat. If you guys have any questions specifically, there's 200 people on. So don't forget to include trading fees in your risk reward calculations. Yes. So we'll talk about trading fees right now. So if you use 100x leverage and you market buy, your trading fee automatically is going to be around 15% of the capital requirement. So that means that you need to have at least a 15% profitable trade in order to profit from the actual trade that you're in. 50x, it's 7.5%. 25x, it's like 3.75%. 10x, it's 1.85%, something like that. But so you have to understand these fees, you have to understand the fees when using the leverage, because the higher the leverage, the higher the fee. So you have to understand those, and you have to calculate those with your position sizes for it to make sense. So again, let's say we're going to take a trade. We're actually currently in a trade, not on this account, but on another account. Right now, we are in a short. Okay, we're in a short from about 7,200, 7180 to 7,200. I laddered in. So I'm going to show you how to ladder in a trade right now. So let's say I want to short from 7180 to 7,200. So what we're going to do is we're going to say limit 7180. Okay. Now, let's calculate our position size. In this account, I've got 7.35 Bitcoin. So 7.35 Bitcoin times 0.01, that's my risk amount, say 0.0735. And we're going to divide in our stop loss is, let's say our stop loss is from 7,200. Let's just say it's this red bar, 7,244. So we have to get this really, really exact. So 7,200 to 7,245, 0.5, so 0.63%, okay? So this is going to be a little bit different because what we're going to do is we're going to divide by a number that's less than 1. So we're going to divide 0.0063, okay? Because that's our stop loss. So it's not 1%, it's 0.63%. So we're going to equal. So my position size is 11.6 Bitcoin. Okay. So 11.6 to get my quantity USD, I'm going to multiply that by the average entry price. Okay. So 7180 to 7,200. So my average entry price will be about 7,190 equals. So 83,883. So that's what I'm going to put in this quantity. Okay. So you can see right here, 11.4 is my BTC. And how do we get 81,800? So 81,883. Well, I'm probably going to have to use leverage. So if I use 5x, my initial capital cost is going to be 2.3109 Bitcoin out of my 7.35. If I use 3x, it's only going to be 3.8401. If I use 2x, it's going to be 5.75. So let's just use 2x because that gives me the highest liquidation price and the lowest fee. Even though I'm using limits, you're going to get a rebate back. So what I'm going to do is I'm going to scale this position in. Okay, so 81,883. Let's say I'm going to do 3 orders in the laddered area. So what I'm going to do is I'm going to do this number and I'm going to divide this by 3. Okay, so this gives me 27,961. So I'm actually going to use this 27961. And what I'm going to do is I'm going to do this 3 times 7180. I'm going to sell short with a limit. My stop loss is going to be 7245.5. You don't have to set this right away, but you can. And so I'm going to do that and I'm going to click confirm. So that's my first laddered entry, 7180. And I'm going to go 7190. Same amount, sell short, stop loss. We can just leave it where it's at right now. I don't typically enter them right away. I like to manually enter them, but we can just enter that again. So we're laddering into this trade 7,200. Sell short. Okay. So now what this is going to do is as it moves up, I'm going to fill this position, fill this position, fill this position. And what that's going to do is that's going to give me an average entry of 7190 of this trade. And then my stop loss is going to be 7246. So from here, it's going to give me, well, it's going to give me a little bit higher. So 0.8%. So I should have calculated my stop loss around 7190, but that's how I would ladder in. Now, when this fills, then what I can also do is I can also ladder out my exit down here. Okay, same concept. What I would do though is I would click buy long instead of sell short. If that makes sense. Oh, can I shrink my head? Yes, I apologize. Let me see where I'm at. I didn't actually look. Okay, yeah, let me move me down. All right, sorry about that. Dan the man. Okay. Never market. Well, there's times to market. If you're in a trade like this where it goes parabolic and you want to try and like exit out at the top, you pretty much have to market because it's really hard to get limits to fill unless unless it starts moving down here and you know the exact place that you want to exit. But you can use like order flow reversal strategies. Okay. All right, so basically forget about money as a bubblegum associated commodity. Okay. Any specific questions on risk management, guys? So we've got, all right. All right, let me see. All right, so if you guys don't have any questions, I mean, I guess I can end the stream a little bit early, but so that's how to ladder into a trade. And then that's how we cancel our order. So what I was saying before is with the leverage slider, it'll automatically calculate the order cost. You don't have to do that. So let's say with that example we were using before on $5,000, you can see that the initial order cost is 0.3512 Bitcoin. You can see that on 3x, it goes down to 0.235. So this is the initial margin requirement. So if you're liquidated, so if I click sell short, it'll show my estimated liquidation price. So if that liquidation price gets reached, then what that means is that the capital requirement for margin has been met, and it'll basically forfeit the trade and the position. But if you use cross margin, okay, I want to explain the difference. If you use cross margin on a trade, your estimated liquidation price is super high because it's basically going to continue to take money from your account until the account is down to zero. So you always want to make sure that you're using stop losses with cross margin. Other than USDT trading, what does Bybit have over BitMEX? Well, their USD pairs, the altcoin pairs on BitMEX are all based in BTC pairs. So you got the, and they're all futures contracts. So they're all, the A to Z 19 contract, the EOS Z19 contract. So it's a little bit of a cleaner platform in that everything is ETH USD, EOS USD, XRP USD. It does not have futures contracts. I believe those are coming. But it's also, for me, it's been faster than BitMEX. I was trading on BitMEX for over a year before, all the stuff happened with BitMEX. They're getting sued. Their exchange kept getting overloads. And one thing about Bybit that's really interesting is if you compare the Bybit and the BitMEX charts, all of the Bybit wicks or the BitMEX wicks, because of the overloads, are typically $10 to $15 more. So like, let's say this went down to 64.12 on BitMEX, you might see it actually go down to 63.80 or 63.90. And sometimes I've seen, upwards of $20, $30, $40 wicks, which is like, pretty crazy. They also have USDT, which is very, very helpful. And also the withdrawal times are faster. You can withdraw, I think, twice as many times throughout the day as BitMEX. And also, Bybit really listens to the community. Ben is on Twitter all the time. They're constantly doing these competitions, really cool stuff. The community, they've implemented 3 features that I specifically have requested, which is amazing. And good luck getting a hold of Arthur Hayes, right? I mean, he's in the mountains, he's in the jungles, and good luck talking to a support team at BitMEX. Or getting somebody on, social media to actually be able to answer your question. So I like that they're accessible. I like that they're based in Singapore. So for all those reasons, that's why I use Bybit specifically. I need to review the video one more time and take notes. So much good information. To use the same strategies when hedging a portfolio. So one thing that I would say is if you want to hedge, what you can do is just a 1x. Like if you want to just like maintain like your portfolio USD value, like let's say you get a massive USD, then you can like basically just show your whole account on 1x. And so as the price goes up, what's going to happen is you're going to lose out on BTC value, but it's like a synthetic cash position if you don't actually want to move to USDT at any time. But one thing that I recommend for newer traders is the 20-80 rule, where 20% of your capital is kept in Bitcoin and 80% of your capital is kept in USDT, just so you hold your USDT value, and it allows you to trade against your USDT portfolio by using leverage and margin and stuff. Is it okay to take less than 1 RR trades sometimes if you really think that the trade is right? That came from Andre. So that I would say that is not recommended unless you have a very high win ratio. Because after a while, if let's say your win ratio is not 70%, 80% high, and you're taking less than 1 RR trades, you're really going to struggle to stay profitable because you're going to constantly, like if your stop loss keeps getting triggered and your only take profit is, let's say 0.7, but your stop loss is a 1R, like a full 1% capital risk, then the amount of rewards that you're hitting aren't going to make up for the stop losses. So let's say after like 5 trades, 3 hit stop loss and 2 hit winners, you've had a 3% drawdown, but 0.7% gain. So you really only made 1.4% capital on your portfolio, but you've lost 3%. So you're really down 1.6% total. And that's, after a while, you're really going to dig yourself into a hole. So it's in my opinion, I would always recommend shooting for at least a 2-to-1 RR on your trades. And you really want to make sure that you're tracking it. So leverage is irrelevant when calculating risk/position size. If my 1% risk size is 0.01 Bitcoin, I can adjust the leverage bar till I get to my position size. Absolutely. So why would you ever need leverage? Okay. Remember, the goal is consistent gains. Okay. So you're only risking 1%, but your goal is to gain 2% or 3% on your portfolio balance. So let's say you've got $1,000. Okay. Whoops. And you win a 3% trade. So now you're up to 1,030. Okay, so this is your new baseline. So your next trade, you do the same thing and you win 3%, 30.9. So now you've got, let me maximize this. So now you've got 1,030 plus 30.9. Okay, so you've won 2 trades in a row. Well, let's say this one, you risk, you lose 1%. Okay, so you lost $10, 10.609. So this minus this equals that. Whoops. Okay, hold on, where are we at? This, okay, minus 10.6 equals 1,050. All right, so you won 2 trades, you lost 1. Now you won another trade and you won 3%. So you're keeping your trades a 3 to 1 RR. Okay, so 31.5. So this plus 31.5. So as you can see, your risk amount, you know, keeps going up, and your stop loss. I mean, all this stuff scales, and so after a while, you're going to be gaining. What most people do is they've got $1,000 portfolio, and they're just like, you know, F it. Let's go 1,000 times 50x leverage. All right, cool. I've got a $50,000 position size. Well, what happens if you hit your stop loss on this? Okay, so if you hit a 5% stop loss on your full account balance, so let's say you've got what did I say? $1,000 times 0.05. So you just lost $50. So now you're down to $950. It's going to be really, really hard to continue to come back from that. You know, it's better to lose $10 than it is to lose $50 or 5% of your capital. Why ladder in? To avoid getting hurt? Well, you can ladder in to, why ladder into a trade? Well, it's because you don't know what you're going to get filled and what you're not going to get filled. But sometimes, you know, like if you see these wicks up here, you can see this is a strong supply zone, right? So maybe you just want to bet that the next time it tests this level, it's going to get rejected again. So maybe you want to ladder in from 7,200, 7,210, 7,220, 7,230 to give yourself an average entry of 7,250 or 72.5, whatever the case, 7,205. So whatever the case that may be, you're going to ladder that entry in because it's really hard. So let's say you're trading with 7 Bitcoin and you want to get a position size of 300,000. Okay, well, it's really hard to get one 300,000 fill because it's going to create a wall. So it's easier to fill 50K, 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 but your position size is basically relatively the same, your entry price is basically the same because you can enter here. Now, what you can also do is you can do a laddered staggered entry where you can do 25%, 25%, 50%. So you try and get the best fill at the top of the range of whatever your trade strategy is. Do you ever change your stop loss level as you see the price action developing? Now, you don't want to change your stop loss just because the trade bounced a little bit, because you're going to lose a lot of trades that way and you're going to miss out on a lot of potential profit. What you want to do is you want to make sure that your stop loss is at what I call the invalidation level of your trade thesis. So if this trade, this 7,200 trade comes up and breaks 7,230 and closes on probably like a 15-minute candle, I'll probably close this trade because it's invalidated my thesis that this is in a downward sloping fashion and that this is an impulse down consolidation. There's a lot of mixed context on this. It's basically in a choppy range. So I'm trying not to trade too much mid-range. I'm trying to trade the extremes of the range when possible. Okay. But you can see we had this nice trend line, and then it broke down, retested, and then looks like it wants to head lower. I got into this space listening to HODL Bitcoin, but discovered I really wanted to be a trader. When I was in cash, I felt like I was in a short Bitcoin position. I had to shake that. There is nothing wrong with being in a USD position because it protects your capital. Hey, if you need a mod, I don't know how to, all right, cool. All right, thanks, Edward. I just added you as a moderator, buddy. Might be outside of the scope of this video, but what is a good example size sample size of trades when evaluating a strategy. I would say at least 100 trades is a good sample size, but the more the better. The more data you have, the better. And you always want to make sure that you use a tracker. And to be honest, I do it by accounts. I have multiple accounts to be able to trade different strategies. I have algorithms, I have bots, I have long strategies, short strategies. I trade Ethereum, and I try and keep them kind of confined. And I've got a very organized system of how I do it. But that's one way to do it. The other way is just keep a very Edgewonk is a trading journal. I don't like it too much for crypto. I was developing one of my own, but I got distracted with some other stuff, and so I never actually had that go through. Look at the last 15 minutes. That's about as boring as it gets. That's in a whole hour that it's been basically 71.44. We got this nice little spike before, but we're seeing a lot of sells in the market. So, all right. So anything else you guys want to know about specifically about margin trading? Oh, and I'll leave the link to the... we've got 240 guys. So if whatever you guys want to see, just let me know. Now, I did have this position size calculator. I'll show you what this looks like. Again, this was from CryptoZide at CryptoZide. He allowed me to use this with you guys, but this has your position size calculator, your targets, your target percentage, your risk percentage, your stop loss, all that cool stuff. It kind of calculates this out all for you. So thanks to him for doing that for me. But that is included on that link that I put down below. Jacob, how can we get in on some of your trades? I do have a trading community, and the thing with running a trading community is it's not so much about me. Henry Ford is a very, very smart guy, and what he said is he was smart because he was so successful because he surrounded himself with people smarter than himself. So, the whole point of me having a trading community isn't to have access to me. I'm a good trader, but my job and my goal is to find better traders than me that have specialties. So I have a very good altcoin trader. I have a very good swing margin trader. I have a very good scalp margin trader whose results are just phenomenal. And so that's where you guys can get access to that stuff. And so that's part of my trading community. Yes, I do provide my trades, but more importantly is I find and I hire the best and talented and most talented traders, and I've got the capital where I can make it worth their while to be able to come in and share their trades. Does the part we hold in our wallet count as part of the portfolio? Is portfolio the part we have in the trading platform? Mark, that is on you to decide. You, depending on how much you want to risk. Let's say your long-term investment capital is $100,000, but let's say you want to take $10,000 of that and make that your trading portfolio. It depends on if you feel like you're willing to risk 1% of $100,000 or 1% of $10,000. So I can't make that decision. That's up to you to decide that. What are your thoughts on U.S. regulations, and do you think it will impact leverage on Bybit or BitMEX? I do think eventually, yes, we will see a curtain calling of a lot of margin trading and whatnot. But, right now it's kind of a black box. There's not a lot of regulatory clarity. There's actually no regulatory clarity. And, in my opinion, leverage trading has a lot of benefits and features that just regular trading doesn't have, but they still have penny stocks and other things that are far more risky than margin trading. Say hi to Chinggis for me. I will, man. Most margin traders lose money, even so many claims. Yeah, I mean, trading is not easy, right? I've never made it as an easy thing. If you follow me, I post my losing trades as much as my winning trades, and it took me a long time to get good at trading, and it took me a long time to become a very consistently profitable trader. And in crypto, the beauty of it, see, I started out in the stock market, but in crypto, the beauty of crypto is it's 24/7. And there's a million different assets that you can trade on a 24/7 basis, meaning you can hyper learn what most stock market traders, it takes them 5 years to learn. You can learn it in 6 months. I see some crypto traders, and they blow away Wall Street traders with their knowledge. And Bitcoin is a specialized asset in that it has a lot of different metrics and indicators that you can use that are non-relevant to the stock market. You can't use balance sheets, earnings calls, PE ratios, cash flows, any of that stuff. Bitcoin has a lot of on-chain analytics. There's a lot of other things that kind of go along with it: funding rates, open interest, open values, all kinds of really fun, cool data and analytics that you can use to try and figure, this wild and crazy market out. What's the URL to the community? It is signalprofits.com, Mark. Thank you so much for sharing with us your experience. How much do you personally risk per trade? 1%. Yeah. Sometimes I'll go to 2 to 3%, but how long did it take you to become profitable consistently? My initial beginning was pretty crazy in that I started with like 5,000. I got to 50,000 in like 3 months trading crazy options plays. And then I lost 40,000 in less than a month. So, it was a wild roller coaster ride, right? But consistently profitable, I would say about 2 years. But I was trading options, and options are a very tricky game. And then I got into biopharmaceutical stocks, which if you talk to any stock trader, it's basically, that was the crypto of the stock market. It was very wild, very new, nascent, meaning that it was very new, and there wasn't a lot of information, and they were crazy. I mean, up 5,000%, down 300. I mean, it was nuts. I mean, these things would move all over the place, and it was really just based on whether or not like a drug trial was approved or not approved, or a merger, or they were being acquired by Pfizer and stuff like that. So it was a little bit different. Do you use different ladder entry exits for different time frames? Yeah, time frames are a whole nother thing that we can talk about. Why do you think Asian traders beat the English traders so badly on the recent competition? To be honest, Asian hours trading was far more profitable than the US hours or the London hours. So there's typically three trading times. This comes from Forex, but there's what's known as the US Open, the London Open, and the Asian Open. And the Asian Open, which is, the early morning hours for the US, between midnight and 5 a.m., far more volatile, far more price action, and the U.S. trading hours was like a flatlined EKG heartbeat. It was so boring. It was like watching paint dry, and there was almost no trades to be had, besides maybe the day before and the day after Thanksgiving when the competition started. So it was a little bit of a frustrating experience because there was really not much volatility to trade off of, and I'm very picky about my setups. Okay, I'm gonna take one more question and then I'm gonna hop off. We've been on for quite some time, but I appreciate you guys hanging out. There's over 300 of you. We've been on for an hour, and I think we've covered a lot of things. And I want to make sure I had some other stuff that I wanted to make sure. Open trades, splitting portfolio, expectancy. Oh, okay. There was a couple of other things here. Hold on, let me check. Drawdowns recovery. All right, we covered all that. Win rate, RR. Okay, so one thing that I didn't put on here is how to calculate your win rate, but that is on the cheat sheet formula guide that's in the link below, and I'll put that in the link here. All right. And that also comes with the position size calculator. So make sure that you guys hop on Twitter and thank CryptoZide for that. CryptoZide. It's a smaller account, but he was nice enough to put that together for me. So I appreciate that. I'm very thankful for you for sharing your knowledge. Thanks. How about XRP? This is not a chart request time. This is just, we're focusing mostly on risk management. Can you touch on different time frames before you go? You know what? I will save that for a whole nother webinar. JNev, I appreciate that though. You made a video recently about trading the trend, whether trading with or against the trend. Do you have a percentage stop rule for each to manage the risk? No, I do not. I can do a stop loss video down the road. But stop losses are just invalidation levels. You can use a lot of different things for them. Fibonacci levels, pivot point standard levels. You can use VPVR, VWAPs, all kinds of different indicators you can use to find out your stop loss and your entry and exit. All right, guys. Well, hey, I appreciate you guys for attending and watching. If you want to get this information, I posted the link in there. You're always more than welcome to join my free trading community on Telegram. I'll post the link below there as well. If you want to sign up for Bybit, it's not obligated. If you're new trading, I would recommend always trading on the testnet first. I am doing this series with Bybit in partnership with them. I will be, and everything that I do is always transparent, it's always disclosed. And I'm really excited to do this because I have seen a lot of people complaining about margin trading. But in my opinion, if you really learn how to understand what it is and how it works, it's one of the most beneficial things you can use with Bitcoin as you're learning how to trade. And not everybody's designed as a trader, okay? You might be more designed as an investor, and that's okay. There's nothing wrong with that. And I would not knock anybody for investing and holding Bitcoin. It's one of the best performing assets of the last 10 years. If you want to trade, you really just have the passion for learning how to trade because it allows you to make income on a weekly, monthly basis. But understand that it is just like a job. You have to treat it like a job. You have to calculate your expenses, your fees, track everything. So if you guys understand that, then you're much better off. Do you ever worry about funding rate, or is it usually too insignificant? Yes, I always look at the funding rate. It's very, very helpful. Do you as a pro still do all this math, or do you get it close enough and do it off the top of your head? I've been doing it so long. I mean, I have like a very, specific idea, but, 7.35. I mean, I know how to calculate this stuff pretty quickly, but my tracking is very insane. Is it possible to download the presentation? Well, all of these formulas are in that cheat sheet guide. All right. Yeah, come on, baby. Got that short coming in. Oh my gosh. We finally broke out of this tiny $1 range. Probably just go right back up into it. And make sure that you have to be, make sure you're very patient. Trading margin, altcoin trading, same thing. Altcoins are pretty risky. Well, altcoins have kind of an added risk because you have to kind of understand what Bitcoin's doing as you're trading altcoins because they can kind of have some negative effects on it. But trading altcoins is kind of like shorting Bitcoin because you think that altcoin is going to outperform Bitcoin. So it's like a synthetic short in and of itself. But you can gain Bitcoin value and still lose USD value because if Bitcoin goes down and the alt goes up, but if Bitcoin goes down 10% and the alt goes up 8% relative to Bitcoin, you made more Bitcoin, but you basically lost 2% USD. So you have to kind of understand that stuff as you're trading altcoins. I do trade both. I like trading both, but that's just because, I'm used to trading alts. I know how to trade alts, and so it kind of comes with that stuff. Do you use 3 commas? Yes, I do use 3 commas. It's very helpful for trading on Binance. Trading margin. All right, guys. Hey, I appreciate you. Thank you very much for watching. And if you guys have any questions or comments on what you think I should watch, leave a comment below the video and or what kind of content you guys would like to see in this series with Bybit. Then just let me know. And also, let me know in the comments if you want me to cover anything more in depth on what we just talked about on this video. Okay, so I'm not taking any more questions. I appreciate you guys, and I will see you on the next one. And I will do, we'll get more live streams in where I can actually go through and we can do, charting and hanging out, drinking some beer as we go through the market. But I just want to get this out here because I think every new trader really needs to understand this information. Do not trade until you get all these concepts really well because you're going to blow your account, and I don't want you guys to lose money unnecessarily. You might lose money because you take bad trades, but at least you're managing your risk while you're doing it along the way. All right, guys. Appreciate you. Thanks so much.